Our next panel is in some ways where the rubber hits the road. You know, an old, very famous bank robber was asked, "Why do you rob banks?" and famously said, "That's where the money is," right? Well, we have a panel of CFOs who all know where the money is hidden, and they're the guys that have to pay for this stuff. They're the ones that have to invest in innovation or decide that they're not going to. And so please welcome them on stage. Give them a round of applause. We have Eric Brandt, CFO of Broadcom, Mark Garrett, CFO of Adobe Systems, and Robin Washington, CFO of Gilead Sciences, a pharma company, biopharma company. Let me start with you, Eric. Now, we're obviously still in a difficult macro environment. The global economy has not yet come back to where we'd like, so the US economy has not either. But you have the slightly ironic situation that even though the consumer markets have not rebounded, the cost of capital is quite cheap. And so as the keepers of the purse, how do you make your decision now? What's your thinking when you think, for example, about the opportunity for M&A? You're an acquisitive company. You think a lot about this. Can you take us through a little bit of your thought process when you're faced with this conflicting a pro and a con in how you think about the money?
Yeah, it's interesting. You know, the issue is, do you change your view of what your return on capital needs to be, and irrespective of the cost of money? I mean, look, you have a return on capital that your investors expect, and you have to make sure that you're exceeding that, irrespective of what the cost of debt. What you can do, though, in today's environment is certainly make some money on that by actually financing transactions with cheap cash or cheap debt, as the case may be. And certainly if you were in the real estate business and you could borrow money at 2% and make 6%, you'd do that all day, every day, till you exhausted all of your opportunities. The issue is, when you're a public company and you have expectations on a return on capital, you really can't do that. You have to weigh the targeted return on capital and your alternative uses of cash, which are usually buying back stock or paying dividends. And so I don't think it changes your view of what your return on capital needs to be, just given the market environment.
Now, just for folks who may not be so familiar, your business model, you're a semiconductor firm, but you're asset-light. You're fabless, as it were. Not fabulous, although maybe you are also fabulous, but fabless. How does that asset-light approach affect how you think about where you park your money and how you invest, again, for innovation?
You know, it's interesting. Yeah, we generate significant cash flow from operations, and this topic comes up in a variety of different formats. But I would say that, you know, we have about 77% of our employees are in R&D, and we have a thesis of the business that you need to accumulate technology and integrate that technology into systems on a chip, and that you have two pools of capital to do that. You have P&L dollars and you have balance sheet dollars. And the issue is, at various points in time, one is cheaper than the other. And probably today, balance sheet dollars are cheaper. And in a tight economy where your targeted EPS and return on investment and operating margins to your investors is relatively tight in a tight market, you try to use your balance sheet dollars as much as you can to augment your technology. Now, we are a serial acquirer, so we've acquired, in the 20-odd years we've been around, we've acquired over 60 companies. And we view that very much as part of our R&D. We're willing to let other people take the initial risk, develop the market, assess the technology, verify that the market's in place, and spend additional money perhaps on the balance sheet to bring that technology in. And to the extent that you can take cash on the balance sheet, particularly cash that isn't earning a lot of money, and convert it into operating earnings per share for your shareholders, we believe we're creating value.
On this theme of acquisition, maybe I'll turn to Robin. Now, your firm is renowned for its products and innovations in the HIV space. Mm-hmm. But last year, you made quite a big bet on an acquisition to bolster your hepatitis C portfolio, if I'm not mistaken. Was it $11 billion, something like that?
Yeah, $11 billion.
I mean, you bet the farm, in a sense, on a company
we don't like to say that, but yeah, it was a big bet.
Well, you know,
it was large.
It was
it was transformational, put it that way.
And if those of you that know the pharma business know that this is an industry with a lot of risk. The innovation pipeline is long. It can take a decade or more to bring novel molecules to phase 3 and ultimately to the marketplace. This was a phase 2
Right.
product that you were acquiring, in effect, right?
Right.
So take us through just a little bit of the logic. Again, we're here to talk about innovation, but from the perspective of people who need to watch the finances, looking at the trade-offs.
Right.
And here, at the moment, we're talking about acquiring innovation, as it were, from the outside. We'll talk a little bit about other ways of doing it. Take us through very briefly how you
we
decided to
thought
make
about
that
that.
decision,
Yeah.
how you financed it, and what were some reasons to pause that
Right.
maybe you reflected on before taking the leap.
Yeah, I mean, I think while our core expertise has been in HIV/AIDS, I mean, overall, we're an antiviral company. As you mentioned, because of the risk and everything, we spent a lot of time in the due diligence, being sure that we not only looked at the molecule that we brought, but the whole landscape of things that were available. And we saw it as a great asset that we ultimately think we can capitalize. You talked about the hurdle rates, and the financial is a part of it, but I think overall, you can buy it, but can you integrate it? Can you add value? Does it bring long-term shareholder value? And we really thought with Gilead's technology or technological and development expertise, along with our R&D and commercial expertise, that we could take this asset and really position ourselves as the leader in hepatitis C. And it's working. I mean, we're not approved yet, but we clearly have been able to progress it, and our shareholders have appropriately
Your share price has
rewarded us.
gotten a nice bump, so
Yes,
that worked
yeah.
out for you. In terms of how you structured the financing, was it with the extra cash you keep in your back pocket, or how do you finance
Yeah,
it?
all the extra cash that we had in our coffers for the most part, along with bank debt and bonds. So we financed about 50% of it. We had just recently been rated, and to your point, we really had to go and explain to our investors, as well as the rating agencies, why we thought this could be transformational and the real value that we thought we could bring to the asset to ultimately increase value.
Okay, so we've heard about one way of bolstering innovation, goosing your in-house efforts by acquiring. We have a serial acquirer who's admitted his problem. He's going to take some remedial steps and seek therapy soon. No, he refuses. Okay, well, remember, acknowledging the problem is the first step. But there are other ways. Some companies set up venture arms, for example. I interviewed Jeff Immelt, the chairman of GE, for my book, and he explained to me that he had set up a venture arm a couple of years ago, mostly so that he could get visibility as to what was going on out there that his own managers weren't telling him, what was so interesting in various parts of energy or healthcare, where he was most interested in. Let me maybe turn to Mark. You have strong views about companies setting up this sort of venture capital arm. What do you think about that approach?
Yeah, we do have a venture arm. It was set up a long time ago, and the idea is to invest in technologies that you might down the road want to acquire or partner with in some way. And from my perspective, that's not a core competency of, at least not of a technology company from my point of view.
Do the guys in that division know you hate them?
No, I don't hate them.
Or they're a waste of space?
But I think, from a use of cash perspective, I'd rather generate cash flow for the business than invest in a company, get a return potentially. That return doesn't show up in the P&L and operating income. It shows up below the line. Investors don't pay attention to it because we're not in the business to make money off of a venture fund.
So you don't get the credit, even when you get a win.
So we don't get the credit
From the
for
perspective of financial markets,
right?
You don't see that.
I mean, where it may make sense is if you want to invest in a company and get a board seat and potentially have a right of first refusal to acquire that company down the road. But just to partner with a company, you don't have to invest to do that, from my perspective.
Now, what does that say about some of the trends towards more open, collaborative innovation? Is there a role for a middle path? Because we do know that one of the ways in which innovation is changing, historically, innovation was a game for the elites, right? A top-down model, we can remember the Xerox PARC or Bell Labs kind of model, and that model worked for its day. There were a lot of great things that came out of it. But very clearly, in the last couple of decades, we're seeing much more of collaborative approaches, user-driven innovations, networked innovation approaches. Yet you guys are all, in many ways, focused on the traditional approach, and IP is quite important, I think, for all of your firms. How do you find a balance between that and casting a net wide, especially given the misgivings about venture funds?
Yeah, I mean, I don't disagree with Mark's point, but even the first all-oral single-tablet regimen for HIV is a collaboration between us and BMS, who's also a competitor. So I do think, to your point, Vijay, collaboration's very important. I mean, we continue to look for innovation. We have a collaboration with Yale University, in oncology, where we're starting to look at different opportunities there.
How have you structured that, just to take that example?
It was through an investment. It's not a venture fund. We've invested via grants and infusion of cash. And there's several, they obviously have a lab there, and we work with them, our scientists and theirs, and collaborate and look at various opportunities. We have a therapeutic area focused on oncology that's still at earlier stage relative to our other areas, but we very much see it as a future opportunity that could ultimately fuel and become a significant component.
I'm curious,
of
how
Gilead's
have you
revenue.
structured the rights on IP for anything that's generated by Yale in that particular?
Yeah, there's definitely a collaboration there where we would share in things that we'd fund as well.
So you would share?
Yes, yeah.
You have rights to part of that stream?
Absolutely,
Okay.
absolutely. Yeah.
There's some disagreement on this. There is a competitor who shall go nameless of yours that's very interested in diabetes drugs, and the collaboration that they've come up with an academic institution is to put up all of the research online. And in effect, open sourcing it. And I asked the head of R&D there, why would you do this? You're a major pharma company, you have shareholders, you obviously care about IP. He said, all those things are true, but this problem is so difficult, that is diabetes. We want the best brains in the world to work on this. We want to benefit from that. And if we had a closed IP system, they wouldn't help us. And so we put up our research online, and then said, well, what is it in it for you? He said, we think we can still get first mover advantage. That because we were involved in this from the beginning, even though the research is up on the web, we still think we're a year ahead of other people because we'll know how to act on it. So there are some disagreements about how to, I think people are finding their way.
Yeah, no, absolutely.
His CFO was less than happy about his approach, but he's a very powerful R&D head, and he's pushing this in that area. But I think companies are trying to come to grips with how do you take fundamentally a historically top-down approach, that's what your corporations are, and make it adapt to a world which is increasingly anarchic, where good ideas are coming from all over, from disruptive innovators, from frugal innovators in the developing world. We'll hear about that in a panel later in the day. And so I think this is part of the challenge. And different parts of companies, of course, have different incentives. You guys sit obviously writing the checks and as stewards of the finances, but you probably have to do battle with your colleagues in the C-suite, I'm sure. I'm going to come to questions soon, as I promised. So why don't we get the house lights up, and people can start thinking about this, and get your hands up if you have questions for our panel. Actually, I already see a few questions, so why don't I do what I promised, so that is devote a lot of time to questions. I see a hand that went up there in that row. Please wait for the microphone and identify yourself, sir. And again, please, no lengthy gas bag speech. Nobody wants to hear that.
My name is Bruce Goldberg. To the last comment you just made, in a capital-intensive industry like pharmaceuticals, what can you say about the idea of maybe giving a risk premium for those people who do that type of innovation and maybe give up some of their IP for a significant patient-related or customer-related problem that the world's likely to be a better place if they solve that diabetes problem a few years earlier?
That's a good question. Robin, do you have a thought?
Well, yeah, I have a couple. I think there is a balance relative to risk premium. I mean, as you know, you mentioned the development cycle is really long, right? So, I mean, I think there are points in times where, as described, you can get to a certain stage, and then you can appropriately invest or bring in investors and share in that risk going forward if things come up. And even in this case where I think the view was the IP's online, I think to the point of once you get to the point of coming up with concepts that can be developed, it's being able to initiate and get them to market that ultimately becomes important. And you really have to have the infrastructure in place to do that.
Thank you. We have a question here. Again, please identify yourself.
Thank you. My name is Nagesh Rao. I'm with the Stifel Family Foundation. I have a question regarding with the how you view the emerging markets, BRICS especially, with respect to tapping into that for market potential. I remember there was a case years ago about Pfizer's business plan model versus, I think it was Roche or Glaxo, regarding the approach towards the BRICS markets, and I just wanted to hear your thoughts on how you view that economically.
Yeah, well, it's interesting. I don't know how much you know about Gilead, but we've had a very interesting approach to developing world, particularly with HIV/AIDS, where we actually gave our IP to generic Indian companies, and where they actually could produce a product very similar to ours in commercial. So we kind of have a global pricing where we can ultimately get access to that product to people that can't afford to pay what people can in more developed countries. And so we basically break even on what accounts for probably about 75% of our patients versus we make money with the other 25%. So it's been a very different model, but I think one that we think is the right thing ultimately to do. As we start to look into other areas where, for instance, hepatitis C, it's a cure disease. So we do see commercial opportunities. So as we think about where we see that happening, and as the developing world has changed over time, we make investments where we ultimately think we can commercialize it and make money, but again, also balance with access as well. So I think something core to our mission is access to patients. So it is a delicate balance, but we think about both of those, where we launch first and where we make some of those initial developments where we can get returns and then appropriately invest it, ensure that we give access as needed.
You know, you mentioned Pfizer and the developing world in your question. If I can perhaps give an example of how we can also think differently. A lot of the frame and how we think about the developing world rightly deals with diseases of the neglected poor and how to provide access to often expensive drugs from the West. But let's also remember that there's a tremendous innovation potential in those very markets as well. And what we're seeing, and I'm based in Shanghai, but across the emerging markets, there was an interesting deal that Pfizer did with India's largest biotechnology company a couple of years ago that I wrote up for us when I used to be healthcare correspondent, which was my previous job at The Economist. And I found it fascinating for the following reason. Pfizer had long been very aggressively dismissive of generic drugs. Understandable, big pharma, quite protective of IP. But Pfizer hasn't been very good at biotech drugs, the stuff that Genentech or Amgen makes. And so they decided they're going to get big into biosimilars. I think most of you will know in this room, biosimilars are, roughly speaking, the generic equivalent of biotech drugs. They're not quite the same, but something like that. And the deal that they did with the leading Indian company was fascinating because all of the IP, all of the R&D was going to be generated by the Indian company. Pfizer was going to do the marketing and distribution, which some could argue is what they're really good at anyway, right? And in other words, they knew, they understood, and kudos to them, that the world was changing, that there was a disruptive innovator. When they wanted to get in on this, they acknowledged with humility that this emerging market innovator was going to be the one coming up with the new IP. And so I think there's role for also that kind of change in how you deal with the emerging world. We have time for a few more questions. I see a hand way in the back. Forgive me, the lights are so bright. Yeah. If you're in the back, you need to sort of wave your arms around and make yourself heard. Please, the lady in the back.
Hi, I'm interested from
Please identify yourself.
Oh, I'm sorry. Laura Shankar from the Artemis Project. We focus around water technology. And water equipment companies are among the least innovative and most threatened by innovation. Probably because water is not something you want to mess around with in terms of innovation. From a CFO's perspective, what is the value of bringing in innovation? So we talk about going outward, licensing IP, opening up IP, but I haven't heard much about the value of listening to the more innovative younger companies in terms of moving your own dial with innovation.
Okay. A challenge to you guys.
Well, we do it all the time, right? As I mentioned, we acquire companies all the time, and we view it as, I guess, adding to the gene pool of the company and bringing in continual innovative thoughts and entrepreneurial thoughts to the company and people who are passionate about the technology they're pursuing. We think it adds a lot of value, and the challenge, right, as the company gets larger, is to maintain that entrepreneurial and innovative flair of a company. And it's very hard if it's just purely inwardly focused.
Well, let me push you on this, because what I heard from our questioner was that how do you value innovation coming from the outside into your organization? It's possible to acquire a very uninnovative company, right? Just because you acquire from the outside doesn't make it innovation. It could be a widget maker that has done the same thing for 100 years, and you just happen to acquire them. It may not in any way improve your own innovation. So do you actually have a premium when you look at an outside company with stable cash earnings and maybe some possible complementarity, but no particular innovation to its business model? Would you look at it the same as one that might have, for example, high growth entrepreneurship potential, something that's different? Do you distinguish in your financial models?
We actually do. We don't buy revenue. We don't buy stable cash flows. We buy innovation. The first question we ask when we make an acquisition, the single first question is, what's the quality of the engineering team, and is it the kind of quality that adds to the whole of the entire organization? And so we frequently buy companies with no revenue or very, very little revenue because we do place a significant premium on the value of the innovation and what that team has done. And quite frankly, sometimes we've bought companies where the technology didn't pan out, and I can think of an example where that team was transitioned to a different technology and built the largest business inside the company because they were entrepreneurial, they were hungry, and they were fabulous engineers.
Great, that's a great example.
Yeah, no, we've done exactly the same thing at Adobe. I mean, I would argue that we've transformed Adobe over 30 years through organic innovation and several acquisitions that were inorganic, Macromedia, Omniture, and we have $1 billion digital marketing business that didn't exist 4 years ago, and that was driven through a lot of acquisitions that, to his point, had incredible talent that brought innovation, and the synergy of that organization with Adobe's organization was compelling.
Now, just while we're with you, it's not only outside that one can find innovation, right? You're internally disrupting your own business model.
Right.
I'd be remiss if we didn't talk about that for just a moment. Can you tell us, for those of you that don't follow the company that closely, you're going, in effect, from selling, say, software boxes for a couple $1,000 to, in effect, software in the cloud as a service for $30.
That's right.
I'm oversimplifying, but that's the concept. That's a huge risk.
That's right.
You're hoping that people will come.
All this
right?
gray hair came from that.
So can you tell us just a little bit about, it's been almost a year, how's it going?
Right.
And especially, again, you're the bean counter, you're the guy watching the numbers. You've given away the chance to get $2,000, $3,000 a pop. Are you getting nervous?
No, I'm not nervous. Actually, I think this is a fascinating process we're going through. We're basically taking $2 billion of revenue, and I bet everyone in this room has bought one of those products, whether it's Photoshop, Illustrator, InDesign, and moved it from an upfront purchase to buying it in the cloud. You can sync, you can share, you can store in the cloud. You've got a community in the cloud, and you're basically now renting the software for $20, $30, $40, $50 a month, depending on what you buy. And it has huge implications to our business model. So we went from, as you said, an upfront purchase to a ratable revenue model. For me, it's great. We get ratable, predictable revenue, predictable cash flows, and we get a subscriber base that's always current. From the customer perspective, they get constant innovation. So we can pump out new technology daily, weekly, monthly, where before they had to wait for the next version of the product to come out. And it's worked really well from an investor perspective. They love the long-term model. They love that we're going to drive more users, and they love that we're going to drive predictable revenue.
Any downside?
So far, no downside. So far, I would argue it's all upside. I mean, it's a little, frankly, dicey going through the transition. This is the big pivotal year for us when we drive upwards of 1 million people that are subscribing. But once we get through that kind of pivotal year, there's quite a bit upside.
Okay, great, thank you. We just have a couple of minutes for one quick question. Do I have any more provocateurs from the audience for our money men and women on stage? Again, I can't see you if you're way back there. I see a gentleman here just with a quick follow-up. If I can have a microphone here. Let's make it a 30-second question and a 30-second answer, please. So we're just about out of time.
Apologies, just a follow-up. I'm a former patent examiner as well from the USPTO, so I was kind of curious, as there's been a lot of talk about intellectual property. Have you guys, any of you looked at the idea of around humanitarian use licensing? And
I'm sorry, say that again.
Humanitarian, what's called humanitarian use licensing.
Right.
So
okay.
The notion of allowing for technologies from the developed world to go to the developing world with caveats and whatnot, and helping kind of fuel the innovation economy in the developing world while balancing the rights of intellectual property rights ownership.
Something for Robin, perhaps?
There are you've heard of the medicines patent pools and things like that we don't personally do it, but participating in those pools that are focused on ensuring that innovation is put together and provided to areas with the best need is something that we're very passionate about and we think is the right thing to do.
This may be beyond the scope of our discussion, but the Supreme Court did rule on a case involving textbooks recently about differentiated pricing or different pricing for different markets and re-export. I imagine the drugs industry is watching this carefully for implications for your business model?
Pricing always. I mean, pricing for value, I think, particularly with everything going on in healthcare reform and not only in the U.S., but globally. I mean, it's a huge most outside of the US are government-run healthcare systems. So clearly innovative, value add, I think is the focus, because it's not just it's the payers that are having a bigger say as we move forward in this economy.
Okay, very good. I'll give you the last word. Thank you all, and please give them a nice round of applause.